There's a smart new website that will change the way you invest using social media.
LikeFolio.
Here to explain,
A team of brothers, Andy and Landon Swan.
of LikeFolio.
And they've always been building out great technology at the intersection of social and trading.
Powered by unique social data. Analyzed by legendary traders. The LikeFolio broadcast starts right now.
I am so excited. I have been wanting to do this topic for a long time. It's been on my mind for a long time, and now we're finally going to sit down and talk about how to eliminate emotion from your investment and trading process, which I think is the number one thing that people struggle with, that people need to be able to overcome.
Human psychology is the trader's worst enemy. There's no doubt about it.
That's right. It's it's like that old saying that in the stock market is the only place where when everything goes on sale, people run out of the store panicking.
Yep. See it all the time.
Yeah.
And it's, even us, seasoned traders.
Yeah.
We get nervous when there's a collapse.
You have to, it's a constant process to eliminate emotion. It's extremely important. And so we have a list here of 6 rules that that we've developed over the course of years of trading that will really help people combat that emotional process or that emotional reaction they might have. Before entering a trade, there are some things that you want to do, and then there are things you want to do when you're in the trade. So let's go ahead and just jump right in.
Let's do it. It's probably important to note that these maximize minimizing the emotional impact, but it's just impossible to completely eliminate it.
That's right.
But these steps have been very, very crucial in improving our skills.
Yeah, they'll make you more profitable. They'll make you more productive outside of your trading.
Absolutely.
And it's just a better way to approach things. So number 1, this is before you enter the trade, have a data-backed thesis. So have some reason why you're entering this trade that you can write down that is based on some set of data, right? So for me, LikeFolio data is always a part of it, right?
Absolutely. We've that's been such a key thing here in the past year and a half or so since we've been utilizing this data. Prior I was really just basing all of my options trades off of implied volatility levels.
Yeah.
If the individual stock's implied volatility was very low respective to its 1 to 5 year history, then I'm buying premium. And if it's very high, then I'm selling premium. As far as determining direction, very, very difficult for me. So I would try to eliminate direction as much as possible. Since we've been utilizing this social data, this LikeFolio data, it's been incredible in predicting direction. So it really throws a lot more strength in my confidence as far as entering directional positions. And I've profited a lot more and put a lot more directional positions on as a result.
Right. That's awesome to hear. And it's true. That's part of forming a thesis. So you might say, for example, it's possible that in the past we might have said the social data for Tesla is improving dramatically. The stock is at $150. It's down considerably. And that divergence opportunity is the thesis for this trade. So my thesis going into a long trade on Tesla at 150 was the social data is improving markedly and the stock has deteriorated to a point. So there's a divergence there. So my thesis was the divergence. And that I could look back on once I was in the trade, no matter whether it went with me or against me. I could look back on that and say, okay, why was I in this trade? And I knew why I was in it. It wasn't just, I have a feeling it's going to pop. It's not, I read some headline or a few people on Twitter said something. It's my own conclusion based on real data and some theory that I have. Might be wrong, might be right, but at least I have a theory.
Sure.
Right? Which leads to number 2 on our list. Before you enter the trade, again, before you enter the trade, determine in advance what will prove your thesis wrong. Right?
Right. I like it.
So as long as your thesis is still intact and the data continues to support your initial thesis, I see no reason to exit the trade. Right? In fact, if the data behind your thesis is getting stronger, then you might add to your trade.
Sure.
But once the data that you used to form your thesis changes and no longer validates that thesis, it's time to get out, no matter what has happened with the stock, because now you're flying blind, right?
Absolutely.
Now you're doing something with no reason, and holding is doing something.
The data has been contradicted or modified, changed. Therefore, you have to do the same.
Right. So what has, in my example before, let's say I said Tesla, I wanted to buy because the stock was down, beaten up, and social data was moving higher and very bullish. Now, what would prove that thesis wrong? Number 1, if social data started to deteriorate, then now I don't have an edge anymore. I don't have anything on the market anymore, so I would exit the trade. Or if Tesla rallied and the stock went much higher and the social data stayed strong, my divergence might not be there anymore, right?
Exactly.
So the divergence was the reason I got into it. Just because the social data stayed strong, if the stock moved up, there's no more divergence anymore. Or there's less of a divergence, that's kind of an opportunity to get out. That's a nice profit-taking opportunity. Because
time to realize those gains.
Yeah, because those profits have. I love taking profit. I love just banking coin, but just like anybody else, I love to make money. But your thesis can be proven wrong in a profitable way as well.
Sure.
So that's number 2, and you got to do that in advance. You got to know what's going to get you out of the trade. Right. That can be a price level. That can be the data that you use to form your thesis, whatever.
Absolutely.
Number 3 is probably the most important, I think. I'm not sure. The next few are very important. They're all really important. Number 3 is position small enough that you can fly blind. And what I mean by that is I want the position you take in this stock or this option or whatever, to be so small that if you lost access to your brokerage account for 4 days, or something happened in your family and you had to leave for a while and couldn't have access to these things, it wouldn't freak you out. You wouldn't be worried. You've got your thesis. You've got a position so small that a major negative move for you is not going to have a major negative impact on your life. I think that's key, because what I constantly see, I mean, seriously, every trader has gone through this. Every trader's done it. And I see it among newbies, especially, all the time. And that is, they get really fired up about a trade and they start thinking only on the profit side, and they go into the position really big, and almost as soon as the position fills, fear starts creeping into them because it just goes a little bit against them. They're like,
it might go 10 cents against them, but that looks huge when you have a huge position. You're like, what have I got myself into?
What have I gotten? Oh, I can't sell now.
Psychology comes into play, and you're screwed right out of the gate.
Yeah, and now you're holding some 3x leveraged bullish oil ETF, that's down $2, and it's like, oh my gosh, if I sell now, I'm going to lose $25,000. My wife's going to kill me, and I can't, buy this thing that I was going to buy. So I'm just going to hold. I'm going to see if it comes back up. Forget my thesis. My thesis is done, but it doesn't matter because I've lost so much. I have to hold. It has to come back. And then now it's down $4. Yeah, you're down $50,000. And it's like, oh my gosh.
It completely blinds you to everything.
Yes.
And it eliminates your ability to think about new positions that could be, solid positions. I think there's also another really strong key to positioning small, it allows you to increase your number of occurrences. So you can have way more positions on. And, in this game, even with strong data and a strong thesis, you're not always going to be right. But if you have strong enough data and strong enough thesis consistently, you're going to be right more often than you're wrong. But you have to spread it out over a solid number of occurrences, and positioning small allows you to do that. You can have multiple positions on with great thesis, and, none of them are going to really kill you individually. As a whole, you might have a 60% win rate, and you're going to be looking good.
Yeah, that's exactly right. You've got to be able to survive and thrive with a 60% win rate.
Absolutely. Even 52%.
52% is fine.
Exactly.
So that's an enormous one. Then you also think about, all right, you've got this thesis and you've positioned into it small. You can add more later. If things get stronger and your conviction gets stronger and you like the trade more tomorrow, that's awesome. Add again. That's fine. I'm all for it. Just make sure that you're doing it in a way that understands, if this goes against me, I don't want to put myself in a position of freaking out.
Absolutely.
You start freaking out, man.
It screws up everything.
It screws up everything. It's like just life, You just never want to put yourself in a position where things go against you and it causes a total freak out.
I don't know how many years it took me to realize all this stuff. I mean, this is stuff that we're sharing here that, we have a combined experience over 30 years of trading.
Yeah.
And it might seem basic, but it's so far from basic.
It is not basic. I mean, I can remember 10 years ago, probably, maybe 9 years ago. So I was 8 or 9 years into trading, more than that. I can remember losing like $110,000 in a few hours because I got into a trade way above my head in terms of leverage.
Was this when you were doing the S&P futures?
Yeah, this is on futures contracts.
I remember this story.
And it's just brutal. And it was just like I described before. I got into it. I got into this trade. I have no idea why I got into the trade. I can't remember.
I remember because you had been killing it.
I had been,
and you were just cocky.
I was cocky. Yeah, you're right. You're totally right. You're right. I was totally cocky. I was killing it, and on a streak, and I thought I could not miss. And I got into this large contract position, and all of a sudden the market went whoop the wrong way.
While you were in the shower, if I remember correctly, like you put the position on, went, took a quick shower, came back.
Yes.
10 minutes, 15 minutes later.
Yes.
You're down 110 grand.
Yes. And, wow, that's a painful memory. I don't even know if I can do the rest of the podcast.
We just dug it back out, man. I remember this story. This is a great one.
Yeah. Well, that's the end of the story. I mean, it's
so funny. It's not funny, but
it was a crushing blow, and it was a great reminder.
Chin check.
Keep your position small, Andy. You're not that good. I
guess we should add, don't ever get cocky.
Don't ever get cocky is 100% correct, because that's right when they come and kick your rear. So obviously, keep your position small. This is the biggest takeaway. You're not that big time.
Yep.
Number 4, define your maximum risk in advance. So this kind of goes along with number 3. But you need to know how much you're willing to risk on this trade. A lot of people don't do this, and it sounds really basic, and it is really basic, but tons of people don't do this. It's one of the reasons personally I love option spreads.
Absolutely.
Because that way, in an option spread, unlike putting in a stop order,
which I hate.
Don't even get me started on stops. In fact, that goes to the shower story. The stop hit while I was in the shower.
And it probably bounced back.
It bounced back big because it was on the fat finger move that some Asian
I remember that.
fat finger thing was, I don't remember.
One of many
that moved the market down like super fast, and then it came almost all the way back. So I come back from the shower. This is the worst part. So I come back from the shower. I look at the screen. I look at the quote, and I'm like, all right, no big deal. I'm down a few points. No, I was out of the position 30 points lower because the stop hit while I was in the shower. And I was just looking at this thing.
That part.
I was just looking at this thing. I was like, wait a minute. My account balance is down $110,000. The futures have barely moved. I'm thinking, what is going on? Look back at the chart. Nice little dip down right to my stop, which executed me out of the trade and just crushed my
good old 30-second V bottom.
Yeah. Oh, so brutal.
Did you vomit?
No, I didn't.
I might have.
I went for I exercised really hard that day.
Yeah, I bet you shook a little.
I did.
I mean, my hands would be shaking. I'd be clammy.
I was so mad. I was out of it. But you got to define your risk number in advance. You know that an option spread, I think, is the best way to do that.
Absolutely.
It also defines the duration of the trade for you in some regard, or the limit of the duration of the trade for you. It allows you to think a little longer than, a stop loss is like, okay, the stock has gotten to this point at this moment in time, and that's enough to take you out of the trade.
That's the key. We should clarify the difference between a stop loss and a defined risk option spread.
Yeah.
Is with defined risk, you define how much money you can possibly lose in the option spread, but you get to experience the entire duration period of that spread. So the stock can go below your max loss point, but it can also bounce back by the end of that duration period.
Right.
It doesn't force you out of the trade if it goes below that max loss point. Whereas a stop, if you have a stock position or an options position where you put a stop in place, that technically defines your risk. But if the stock or option reaches that pain point, then it forces you out of the trade and you are forced to realize those losses with no opportunity for the stock to recover and for you to get back into a winning situation.
That's right.
Big difference.
Huge difference. Huge difference. If I'd have had a different, that 110 grand was lost because of a brief moment in time.
Mm-hmm.
So that's definitely a lesson. I think that, we'll get more into option spreads later. I think that if people don't understand them yet or don't know what we're talking about, reach out to us. But we talk about this stuff all the time on the podcast, so make sure you subscribe.
And I think another point to make here is I do a lot of naked option spreads, which have theoretically unlimited losses.
Right.
But I can define my risk by looking at, say, a 1 to 1.5 standard deviation move. What if this stock moves let's say 1.5 standard deviations? What if this stock moves 1.5 standard deviations during my holding period, which is a highly improbable situation, but could happen? Then, what's my loss going to be in that situation? Okay, there's my, theoretical max loss. That's
right.
That's how I go about mentally defining my risk in these naked positions.
Yeah, I think that's smart too. And also should also point out that when you put a stop loss in, let's say you bought Tesla at $150 and you put a stop in at 125, that also is a theoretical max loss because Tesla could open tomorrow at $60.
Very true. That gap down.
And you're out at 60. You're not out at 125. So a stop is a theoretical max loss as well. Whereas in an option spread situation, the max loss is strictly defined by the nature of the instrument that you're trading.
Yep.
So you be comfortable with that risk. Be comfortable with the full maximum risk that you're taking. If this happens, will I throw up?
Will I start making bad decisions across the board? It's infectious.
It is. I mean, it can infect the other parts of your life.
Absolutely.
You start losing money and you start becoming crabby and you start
losing wives and friends.
Start losing everything. Some people are probably at home like, hey, losing a wife doesn't sound that bad. Yeah, but you don't want to do that way. So, so there we have. Okay, so keep your position small. Define your max risk in advance of getting into the trade. A max risk that you are comfortable if you lose it. Then you kind of had the corollary to this.
Mm-hmm.
I had written this article with 5 points, but then Nick said, "Hey, wait a minute, you're missing one that's very important." And it's the corollary to defining your max risk, and that is automating the way that you take profits. So just take us through the way you think about that, because I think it's very important, and I know very few people do this.
Sure. So it's really important to automate your profit taking because it's so easy to get into a position. Say, for example, we buy 100 shares of a stock at $100 and we have a 5% stock increase goal. So our goal is to realize a gain after a 5% increase in that stock. So we'd want the stock to go to 105 and then we'd exit. 10 times out of 10, you're looking at that. It goes to 105. It's showing some decent strength. You're like, you know what? I'm just going to hold out. No, man, don't do that, because then it backs up down to 95 and you're in a losing position, 80% of the time. So in order to avoid the greed factor, which is in all of us, you just automate your profit taking. You set a good till cancel order to exit that position at 105 in that particular example. This good till cancel position is working the entire time you're holding that position. And by the way, you put that order in immediately after this, buy fills.
So you
fill the price, you fill the stock price, or you fill the stock order. Then you immediately put in the automated profit taking order to sell the stock at 105, good till cancel. It's working throughout the entire holding period. As soon as that stock hits 105, it automatically books the gains for you. Takes your greed factor completely out of the situation. Boom, you're done. You can be on a golf course, your phone rings, it gets a notification that the position's ordered. You shoot par.
Cash register just rang.
That's right.
I like that a lot. I think that it eliminates the other. So a lot of these that I was talking about was eliminating fear and or reducing fear. But that one really helps to reduce greed, which during a trade can become a big problem. So I think that's cool. Automate your profit taking. I need to do a better job of that. I know that's the right way to go. And
so essentially you're defining your max risk in the previous example.
Yep.
But at the same time, you also need to be defining your profit objective.
Right.
Before you enter the position.
Right.
So you're before you enter the position, you're creating your thesis. You're making sure you're in a small size position that's not going to, cause you to get afraid and infect everything else in your life. You're defining your max risk and you're defining your profit objective.
Right.
Then you enter the position. You put in your automated profit taking order and you've got all the other stuff checked off the list already. Boom.
Yeah. Then there are two things that take you out of the trade, and that is your thesis
is debunked,
disproven,
or changes for some reason.
Yeah, or your profit objective is met.
Exactly.
Those are the two things that get you out of the trade, and until one of those two things happens,
hold.
Number 6, do something else.
Mm-hmm.
You have your thesis. You know your data points. You know what'll disprove you. You've got a small position. You understand your max risk. You understand your profit objective, and that will be automated if it occurs. Now, do something other than sit there and watch the screen. Because the other thing that I've noticed with myself in the past and with a lot of other traders that I have watched, mentored or otherwise, sitting there and watching the screen and watching a stock move up and down can have extremely bad psychological impact.
It's stressful.
It's stressful and it's stupid because you're not learning anything by watching the stock go up and down. You're not learning one thing by watching it print 103.63 and then 103.58 and then 103.67 and then 103.62. You're not learning a thing.
You're learning how to self-induce hypertension.
Yeah. So, get away from the computer. Go do something else. Go get a workout in. You've got everything in place from a instrumental perspective, from a discipline perspective, everything is in place. You've got your maximum losses defined. You've got a small position. You've got automated profit taking. Again, you're not afraid to be away from the trade for a while, and you're not going to put yourself in a position where you watch this and you start questioning your thesis or your position based on erratic movements that are occurring on an intraday basis. The only other point I will make on this is you also, when you, that I forgot to mention when I talked about forming your thesis and knowing how to disprove your thesis, is you also need to know when and how you are going to get new data that either supports or disproves your thesis. So, if your thesis is social data based and you want to see, consumer sentiment is still above 95% a week from now, then that I'm going to check it a week from now. If you want to see, I think that same store sales are going to come in at this level and same store sales come out, you need to check that data then. So you need to know not just what the data is that you're watching, but when you should be checking it and how often. So that's going to vary widely by what your thesis is. So it's really hard to come up with rules, but you need to know what that process is going to be like.
And the beauty of that example is it doesn't require you to be sitting in front of a screen watching numbers and headlines, constantly all day. Right. You can know when the date for this event, whether it's same store sales or earnings or something like that, you can know when that binary event is, and on that day you can check it rather than having to stare at the screen and constantly question your initial thesis.
So these are the rules to helping eliminate or reduce emotion in your trading and investing process. I really think that people should listen to this episode again. I think that you should just rewind and listen to it again at some point soon.
It's critical information.
It's critical. It's an article on blog.likefolio.com. If you just go in there and search eliminating emotion, it'll come up. But this is one that should be, kind of printed out and put, I have it printed out and put on my computer monitor.
Sure.
Because it's the most important thing. It's more important than the process that you use to come up with a trade. Avoiding emotion is the number one thing I think that can improve your profitability really quickly. It's just discipline. So I'm really happy that we are able to go through this. So if you like what you hear today, or you have additional rule ideas,
which I would love to hear,
I would love to hear them too, because we want to learn from you as well. And discipline, there are a lot of ways to put discipline into your life and into your trading that go beyond these 6 rules. And so I'd like to hear those from people. Hit us up, Andy@LikeFolio.com, or just on Twitter. Just reply to LikeFolio. Make sure you're following us on Twitter. Make sure you're subscribed to the podcast. Get that emotion out of your system, man.
Get it out. You're going to feel much better. You're
going to have a happier day. You're never going to walk after a shower to $110,000 loss on something that didn't hardly move.
You're going to trade a lot less sloppy. I mean, there's still going to be some sloppy moments, but you're going to trade a lot better.
That's right. Cool. Well, thanks for listening. We'll catch you next time on the LikeFolio podcast. Hit us up.